emerging market central banks need to buy more gold to shore up reserves. There's less of an inclination to make those reserves in the form of US dollars since the G7 seizure of Central Bank of Russia's assets in 2022. It's interesting what we're seeing in the very recent past couple of weeks is anecdotal reports that jewelry demand is coming back.
How long can gold's record-breaking streak continue? In recent days, the precious metal has surged past $4,000 an ounce for the first time ever, marking its most significant rally since the late 1970s. To talk us through this, we're speaking to Deutsche Bank's gold analyst Michael Hsueh in Singapore about the yellow metal's rise and rise. Thanks for taking time today, Michael. Can you tell us, what are the key factors leading to sustained buying of gold?
So one of them is certainly the idea that emerging market central banks need to buy more gold to shore up reserves. And there's less of an inclination to make those reserves in the form of US dollars since the G7 seizure of Central Bank of Russia's assets in 2022. And in addition to that, we're seeing for the first time in 5 years, ETF investors accumulate gold rather than sell gold in small quantities that they had for the previous 4 years.
Right, and in the past few days, you've said that this rally may be reaching peak momentum. What prompts that forecast? Do you feel the prices are reaching their peak? And if they aren't, what will it take for them to reach this peak?
So when we talked about momentum and we looked at a technical indicator of trendiness, it's actually a bit different than saying that gold has reached its peak. So one thing that trend following strategies try to look at is the strength of a trend relative to volatility. And what we found is that the trend is starting to be a bit mature in comparison to previous such trends we've seen in the past 3 years. And what tends to happen when the trend becomes somewhat more mature is that you tend to get more volatility, more downward moves mixed in with the upward trend. So it doesn't necessarily mean that the trend is ending, but it does mean that for systematic strategies, the trend becomes a bit less profitable. And you might take the kind of June to August period as one example of what could happen after the end of the extreme trendiness. And for that example, this year, we didn't really see gold drop by a huge amount. It rather just held steady.
Right. And can you tell us who's buying the gold? Can you talk us through this a bit? Is it the institutions or individuals? And where are the biggest markets?
So one of the big ones that we focused on is central banks and other official institutions. And that's been the case since 2022, as I indicated. And in fact, it's doubled really in size. And what it's done in the process is to squeeze out jewelry demand for the past couple of years. Jewelry demand last year was one of the 3 smallest on record. But it's interesting what we're seeing in the very recent past couple of weeks is anecdotal reports that jewelry demand is coming back, and along with that, bar and coin demand, so physical investment demand. Just today, we heard that there was a Japanese refiner halting sales of very small gold bars, the type that retail investors would get into, simply because of insufficient refining capacity to meet that demand. So there is demand from quite a number of different corners. It's interesting, though, that financial institutions and hedge funds and the like may not be participating in as much with as much intensity as they might have been in the past. One marker of this is we look at futures positioning that hasn't been quite as strong as one might have expected, and also an options measure called the risk reversal that is relatively weak. Usually, if there's heavy financial institution participation, participation, we'd expect to see the risk reversal being stronger than it is.
Right. And traditionally, gold rallies coincide with downturns in the stock markets, but this doesn't seem to be the case right now, with things like the S&P is riding high, bond markets are doing well, the dollar is not showing particular signs of crisis. Why do you think this is?
Yeah, it's a good question. I would share your observation. Unfortunately, I couldn't really tell you why it's the case, but I could tell you certainly that it's changing the investment case for gold. So gold has gone through a number of periods when the linkage with risk assets has gone positive. So the correlation has gone positive. That happened between 2006 and 2013. And it's also been the case since 2020. One of the potential reasons is that when there is a downturn in risk assets, investors will look to take liquidity, generate cash from assets in their portfolio that have performed well up to that point. And gold fits that description in some of the asset market, that in some of the equity market declines. So sometimes gold can be sold to raise liquidity. But leaving that aside, I would say that yes, there has been more of a positive correlation between gold and risk assets in the last couple of years. And so that would potentially take away some of the rationale for gold to be used as a diversifier, as a portfolio hedge. And it might really bring gold in more into the spotlight as, perhaps more of a core asset, something that might be expected to add to portfolios' gains rather than protect the portfolio in downturns.
We've seen some analysts say that the price of gold could climb to $10,000 per ounce by the end of the decade. Now, I know these are kind of crystal ball questions in a way, but what do you think of that kind of forecast, of that sort of scale of increase of gold?
Yeah, I think obviously these forecasters are looking quite far out, so that makes it a bit more plausible. But there's nothing I would necessarily say to discount those kinds of views. One thing that is kind of consonant with that idea really is that we have the U.S. Federal Reserve now looking to cut rates next year. Most investors do expect that. And yet, core inflation, it projects, will not have come down to target quite yet. So that is a kind of indication of, or it's kind of an echo of previous periods when gold has outperformed its financial model, its financial fair value. So in 2006, we had a period when oil prices were rising very quickly. And at that time, the Federal Reserve also indicated that they were going to look through the temporary effects of that oil price inflation. So there is some echo to previous periods of gold outperformance. I think in order for us to kind of consider more carefully whether, higher targets like 10,000 could be plausible, I think we need to think about how long that inflation persists, that core inflation persists above target, and whether, going out a couple of years, if monetary policymakers are still as, I guess, accepting of that inflation overshoot.
We're living in unprecedented geopolitical times as well, and gold has always been seen as a safe haven. Do you think that's more relevant now at a time of apparent global instability?
I think the degree to which gold does directly benefit is, as I alluded to before, the situation of really great power competition and the worry on the part of some governments that their assets denominated in US dollars or euros could be immobilized in the case of future conflicts. So that is a direct way in which we are seeing geopolitics influence the gold price. I think otherwise, in terms of kind of conflicts, crises, and how that can also help the gold price. We are continuing to see that, of course, but from that angle, I would say that tends to be more of a temporary factor and one that tends to fade over the course of 4 to 6 weeks. So it's kind of more the first factor that I think is having a more lasting impact.
And it's not just gold, right? I mean, silver, platinum, palladium, other precious metals are also riding high. How do you read that?
Absolutely. I think that does also play into or is related to the idea of kind of more geopolitical conflict and, let's say, competition, really. And one can also relate this to the pandemic in terms of supply chain resilience. So governments are looking to, I guess you could say, friendshore supply chains to make their countries resilient to disruptions, whether that's intentional or not. And so that's something that we're seeing at the moment in terms of China adding to stockpiles of oil that are helping to make oil markets tighter than they otherwise would have been. And also, the US Department of Commerce is looking at Section 232 investigations into critical minerals, of which the white precious metals are included. So there is clearly a theme of, one could think about it as resource nationalism, but governments and companies as well looking to make their supply chains resilient to any potential disruptions.
Well, we'll have to leave it there. Michael Hsueh from Deutsche Bank in Singapore, thanks very much for taking time today.
Thank you.